So we were just discussing this lack of conviction in Chinese mainland markets. What do investors need to see coming out of the annual National People's Congress to go bigger on risk?
Yeah, I think investors really need to see the recoveries of the business to normal, to feel confident about business growth and the recovery, and to feel confidence into the equity market. Like you mentioned, the National People's Congress is upcoming, and people anticipate more monetary policy loosenings as well as fiscal stimulus to sustain the economic growth and the employment rate in China. So I think there's reason to anticipate more policies to be issued. And for a lot of businesses, we do see a recovery into a high level. For example, the latest, coal consumption data coming in positive zone. This is the first time in the past 3 months, which indicates a recovery of the industrial activities. Also, from a daily life point of view, I think people already observe going back to normal for work, and then 1/3 of the students are back to school. Shanghai Disneyland, for example, reopened this week. So there are a lot of signs shows that a lot of business activities are back on track.
Jun, I agree that at least here in Beijing as well, life does seem to be getting back to normal. But how long can we expect this consumption recovery to last for, given how widespread the unemployment has been here and the fact that many consumers have less spending money?
Yes, I think an economic slowdown is likely to impact the income growth of the consumers. However, I think there are a lot of businesses that are more staple-oriented, more domestic consumption-oriented, that are more resilient towards macro volatilities. So these are the businesses that we want investors to pay special attention to. Despite the fact that macro volatility, there's the overall market overhang, we still emphasize on the importance of stock picking and sector picking because we do see a lot of businesses from a bottom-up point of view still indicating a solid growth around 10 to 15% CAGR for this year, which is very good for investors to hold.
Jun, it's Richard in Hong Kong. Tell me, how much of a concern is a renewed trade war in your thinking?
Yes, I do think having a global perspective is very, very important for investing in China. And we believe that the tension between U.S. and China will negatively impact the market, both from a sentiment point of view and from a fundamental point of view. Currently, investors are focusing on two potential risks. One is the potential trade conflict between the U.S. and China, and the other is the technology sanctions that people talk about. So this definitely puts pressure on China's export business and the technology sector. So we are still watching the development of these fronts, but let's think about it from two different areas. One is that investors still need to focus on looking for businesses that are relatively less impacted by those macro events, like I said. The second one is that we believe in the long run, despite the fact that we anticipate certain supply chain diversification from China to the other parts of the developing market, we think Chinese companies with industrial capabilities, with technology leadership in those supply chains will still maintain a leadership and take the lead for leading the business diversification into other areas. So despite there are risks, we think there are a lot of ways to mitigate those risks driven by the companies and entrepreneurs in China.
Jun, so tell me, what are you buying, if anything, at the moment, and what are you avoiding overall?
Right. So like I said, we do want to highlight domestic consumption opportunities, especially discretionary consumption that took a big hit in the first quarter, but showed signs of recovery. These may include auto parts, duty-free cosmetics businesses, and home appliances. These are the areas that we are buying and we are paying special attention to. We also noticed that domestic travel demand picked up significantly during the May holidays, which we believe that travel will eventually come back sooner or later. So this is also an area where investors could potentially take a look. What we are really avoiding is the upstream commodity business. We think global economic slowdown has a negative impact on the earnings of these businesses. And the earnings of these businesses are very, very volatile. So these are the areas that we are currently avoiding.